The AI market is expected to grow over 36% year on year for at least the next 10 years. We can already see in 2024 it does sit around 234 billion. In 2032 it is expected 2.7 trillion. So this is an incredibly growing market year on year, and with the likes of Nvidia, which is already up over 200% over the last 12 months, over the last 10 years we can see up over 20,000%. We are looking at companies over the next 12 months which are going to significantly outperform Nvidia, which has already grown massively. We're going to look at each of these companies, their historical performance. We'll also dive into some of their underlying metrics, what we like to see, their ROIC, their debt levels as well, and we also want to cover each one individually to give you our take on the expected intrinsic value, our acceptable buy price when we do factor in our margin of safety, as well as what Wall Street is projecting for their price over the next year. Also, towards the end of the episode, we are also going to briefly cover an ETF for those that do also want to gain exposure to many different companies, but also have that sense of security you may not get when picking individual stocks. So each one of these companies have a lot of upside over the next 12 months, and one thing they all have in common is that Wall Street also indicate these are all buys. So without further ado, the first company is Adobe Incorporated. Now this is one that is up around 35% over the last 12 months, and over the last 10 years we do note it is up around 650%, although we can see it is quite some way away from the all-time highs of just under $700. It does currently sit at the mid to lower end of the 52-week range. As we mentioned, a double buy, Wall Street and quant analysts with a hold from Seeking Alpha. And we can see here as well the forward P sitting at 26.83, marginally above the S&P, which trades around 22.5 in today's value. So in terms of looking at the underlying metrics, what we always like to see, and we do focus on free cash flow over the earnings, and it is susceptible to that manipulation by management through accounting. We want increasing free cash flows year on year. Very nice to note with Adobe, going from around 229 in 2014 to 1520 in 2023. Nice to also note it is anticipated to rise very highly into 2024 at just under $20. Now this is one of those metrics we do look on this channel before investing in companies, those increasing free cash flows. In terms of sales growth, where we want to see at a minimum 3 to 7%. Nice to note for Adobe, double-digit increase year on year. 10% in the more recent year of 2023, and on a trailing 12-month basis, it does have that 11%. Numerically speaking, then, they have pretty much times their top line by 5 over the last 10 years. 4 billion in 2014, just under 20 in 2023. What we also like to note is those shares outstanding. They are doing share buybacks. They have returned some of that excess cash to shareholders. 508 million in 2014, 458 over the last 12 months. In terms of ROIC, an incredibly important metric you need to consider for companies before you invest, ultimately gives us faith that management are able to effectively allocate their capital. Not only is it very strong, but it has been increasing over the last 10 years, 33, 32% over the last 2 years, trailing 12 months very strong at 36. This does make this very attractive to those potential investors. Margins, not only are they very strong, as for the operating side, we do want to see a minimum of 16%, but we note operational efficiency, it has been increasing over the longer term, 35% on a trailing 12-month basis, and free cash flow margin, whilst here we look for a minimum of 5% that you typically see for the majority of companies, Adobe very, very strong consistently over the last 10 years, 36% in the more recent year. Net debt to EBITDA, very important, as this does correlate to the balance sheet strength. EBITDA referring to the earnings before the interest, tax, depreciation, amortization. These are the number of years it would take the company to pay off all of that debt net of cash on hand. 0 over the last 4 years, 0 into 2024, indicating it won't even take Adobe 1 day to pay off all of that debt net of cash on hand. Now let's jump into the valuation model. As always, if you do enjoy this type of content, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. On this channel, we do typically run through every single one of these models. Today's episode, we're looking at the cheap 5 AI stocks, so let's get straight into it, into the final calculation. And in today's episode, the intrinsic value $652, the average of the two that we have used today. Now, in terms of the current price, around 482, and we do start off with a margin of safety. As always, we use 10% and we only execute on that if we believe it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, in today's episode, it would be a buy up to $587, and then we keep going till it's near the current trading price, so we know what the MOS level is for today, and we can see it isn't too far off that 25%, so up to $489, we do see Adobe as having a 25% margin of safety. In terms of Wall Street, well, they see a share price of $625 over the next 12 months, upside of 30%, indicating this to be a very strong buy in the AI space. But as always, let us know your thoughts. Is Adobe one you have been looking to pick up? As we can see, looking very strong, 25% MOS level, 30% implied upside. As always, let us know your thoughts as we do go along these today below. The next stock that we are taking a look at is Fortinet. Now, we have another double buy rating and a hold from Quant. It is trading in the mid to lower end of the 52-week range with a forward P just under 35. Now, we do note over the last year it is down around 10%. Over the last 10 years, however, very strong performance, up 1,307%. And we do also note all-time highs sitting around that $80 mark, July 2023. So again, not that far ago. In terms of looking at their metrics, well, free cash flow, again, another very common theme. They have been able to increase this over the longer term, looking very, very consistent and very healthy with the increases. 2024 expected to continue that trend, which is always a great sign to see. Sales growth, double-digit growth year on year, very, very nice. It is a sign of a company that is growing its top line at a very rapid rate, 20% in the more recent year. And when we look at it numerically, it has gone from $770 million in 2014, $5.3 billion in 2023. On top of that, they have also done share buybacks as a net point over the last 10 years, reducing it down to $782 million in the latest period. So then we move on to the ROIC, looking absolutely phenomenal over the last 4 years. We're talking highs of 203% just in 2023, trailing 12-month basis 136%. Only one other time on this channel when reviewing stocks have we seen an ROIC in the triple digits, so that is a very positive sign. Hopefully that does continue as it makes it, as we said earlier, incredibly attractive, as that is one key metric investors do look at. In terms of operating margin, from 2019 where they did hit that minimum we want to see, they have been increasing it year on year. In fact, from 2015, lows of 2%, it has been operating efficiently, as we can see, 24% on a trailing 12-month basis. This is a very strong sign. Lots to like about Fortinet. Free cash flow margin, very, very strong and very healthy, 33% over the last 2 years. This is definitely an incredible company to consider. And to make things even better, 0 across the board over the last 10 years. I cannot discount or emphasize enough how important that is. It won't even take them 1 day to pay off all of that debt, net of cash on hand. So what about the valuation? Let's jump in, and don't forget you can grab a copy of this valuation model to get to both the intrinsic value and acceptable buy price of companies in your own portfolio and those on your watch list by clicking on the pinned comment below. Intrinsic value then just under $76, a 10% margin of safety, a buy up to $68. At 15%, a buy up to $64. And at 20%, we see pretty much around the current trading price, a very nice MOS level for a very strong company. It is one that we are also considering add to our portfolio, and we may at a later date if there is a lot of people wanting a deeper dive of this company. In terms of Wall Street and their forecast over the next 12 months, well, they have a price target of $73, just slightly lower than our intrinsic value with implied upside of 20%. As always, let us know your thoughts about these companies. We then move on to ON Semiconductor, another double buy rating and a hold from Quant. It is trading towards its 52-week low, and as we can see, a forward P of just over 18, below the S&P 500. Over the last year, it is down around 14%. Over the last 10 years, however, as we can see, up 766%. When we take a look, we do note all-time highs around $105. So when we take a look at the metrics, again, it has been increasing over the longer term, 38 cents in 2013, 369 in 2022, although we do note some inconsistencies and also a drop expected into the next year. When we take a look at sales growth, for the large part, strong double-digit growth last 2 years, 24 and 28%, so it is a positive sign. And when we do look at this numerically speaking, we can see they have nearly tripled their top line 2.78 billion in 2013 to 8.33 in the more recent year. Shares outstanding pretty much flat given they have issued shares but also done share buybacks. It has gone from 451 million to 449 in the latest period. When we take a look at the ROIC, ideally we want a minimum of 10%. We can see that has pretty much hit that criteria for the majority of the last 10 years. 2022, 29%, trailing 12-month, 24%, still very strong. In terms of the margins, well, it has been very inconsistent. The last 2 years looking very healthy, as well as the trailing 12-month. And the same to be said for the free cash flow, although every single year, bar 2019, it has been above that 5% minimum, 20% over the last 2 years, 7% on a trailing 12-month basis. We then get to the net debt to EBITDA, 0.18 in 2022, 0.33 on a trailing 12-month, and 0.36 on expected next 12 months. Looking very healthy. Again, a third company which has a very strong balance sheet. And again, this is one that is heading towards those 52-week lows. In terms of the intrinsic value then, in today's episode, we are arriving at around $97 with a current price of $73.68 at the market right now. In terms of a 10% margin of safety, a buy up to $87, at 15% up to $82, and again we keep going till it's near the current trading price, pretty much around the 25% MOS level up to around $73. In terms of Wall Street and their expectations, well, over the next 12 months, they see upside of 22% and their buy of $90, indicating this is a one, again, to seriously consider for the portfolio. We continue the trend with AI stocks and we move to Alphabet, and as we can see, a double buy rating from Seeking Alpha Wall Street. However, with the other stocks that were a hold, Quant give this a strong buy even at its 52-week high. Again, this is one in fact that has recently paid a dividend, and we do see the forward P around 23.4. Over the last year, it is up 47%. Over the last 10 years, as we can see, 529%. In terms of look at the metrics, well, we do get a dividend safety score, as this is one of our first dividend paying companies today. It does look to be 80, looks to be safe, and a market cap of over 2 trillion. It is a mega cap company. Now, in terms of looking at the metrics, as we can see, there are other metrics, but today we want to jump straight into the important ones. We have the free cash flow, 89 cents in 2014, 550 in 2023, 649 expected over the next 12 months. So those free cash flows continue to increase year on year. In terms of sales growth for the March part, double-digit increases to their top line year on year, 9% in 2023, still very strong, 12% on a trailing 12-month basis. So for the next full year, we should be looking to see again that double-digit trend continue. Numerically speaking then, 66 billion in 2014, 307 in 2023, and they have also done some share buybacks. In fact, they've bought back around 1 billion shares over the last 10 years. And based on their latest investor presentation, this is something that they do expect to continue over the next few quarters. ROIC not only increasing, but above the minimums we want to see. Last 3 years in the high 20s. Trailing 12-month basis, 30%, looking incredibly strong. Again, one of the very important metrics that investors do tend to focus on. Operating margin, well, above the minimums of 12% and consistently above. Some signs of operational efficiency over the longer term as well. And the same can be said for the free cash flow, looking very healthy. There isn't really too much to fault with this company. And again, zero across the board. It won't even take Alphabet 1 day to pay off all of that debt net of their cash on hand. In terms of the valuation then, it is made up of these two models, and the intrinsic value comes at just over $208 with a current price of $178, a 10% margin of safety, a buy up to 188 at 15%, pretty much around the current trading price, which for a company that has just paid a dividend is at its 52-week high, does show that this is still trading at some good value if you do believe in this company over the longer term. We do, however, note with Wall Street, they do see upside of around 10%. Their target price, 196, implied upside of 10%. The next stock that we are taking a look at, it is Snowflake. Again, a buy rating from Wall Street and a hold from the other two. It is trading towards its 52-week low. Over the last 12 months, it is down around 6%. And when we take a look at the metrics, nice to note that it has turned from negative in 2019-2020 to positive and increasing 2024-229. Again, the trend expected to continue at 299. In terms of sales growth, well, they did have some years of triple-digit growth, 2020 to 2022, and even with the slowdown in the more recent year, 36, looking very strong. It is a fast-growing company. In fact, it has gone from 100 million of sales in 2019 to 2.81 billion just in 2024. One thing to note, however, they have been diluting your position if you have been a shareholder over the longer term, from 38.2 million in 2019 to 328 in the more recent year. When we take a look at the ROIC, it is negative across the board, which does show that this company is yet to turn a profit. So one thing that I would say just to keep an eye on moving forwards, we can see, however, across the years, they have been reducing that negative operating margin. Hopefully it won't be too long before we do see them turning operating positive. Free cash flow margin, a different type of story. We do note over the last 3 years, free cash flow positive, and in fact 2024, 27% looking very, very strong. Net debt to EBITDA, having said that, having the fact that they aren't turning a profit just yet over the last 3 years, and in fact expected next year, their balance sheet looking phenomenal. Not going to take them, as we said earlier, one day to pay off all of that debt net of cash on hand. So let's jump into the valuation. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of those videos as they drop. 21268 as an intrinsic value, 10% margin of safety, bar up to 191, 15% up to 181, and we keep going as always till we're near the current trading price. Now, we're not quite at a 25% MOS level yet. In today's episode, around 20 to 25%. In terms of Wall Street and their expectations, well, as we can see, their price target $208. They see upside of around 27% over the next year. So again, looking like a very strong consideration for the portfolio. But as always, do let us know your thoughts about these stocks as we go through. Now, before we do jump into the ETF, just to let you know, we have released our latest free weekly article, 20 undervalued dividend stocks you need to consider for the portfolio. If you want to gain access to this or any other articles, all completely free, do click on that pinned comment and you gain instant access straight away. And one thing we do want to draw your attention to, how to find undervalued stocks. We run through all of the websites and resources that we use on the channel, so if you do want to take a look yourself, you can follow along. Now, one thing that we just want to point out, there will be people who do prefer to look at ETFs, and there is one that you can have for your consideration. It is the iShares Robotics and Artificial Intelligence Multi-Sector ETF. Now, in terms of expense ratio, it is on the little bit of the higher side at 0.47%. But again, if you are looking for any of these funds, they will typically, especially the AI ones, charge a more expensive expense ratio than the likes of the S&P and others. In terms of their performance, well, as we can see, over the last year, they are up around 10.64%. And over the last 5 years, if you have been a long-term shareholder, around 8%. And since inception, 7.57%. What are the type of holdings that they have? Well, first thing to note, their largest position, MicroStrategy, does have a weighting of 2.62%. So they do hold many funds with very minimal weightings. Their top 5, as we can see, have Nvidia, ARM Holdings, Spotify, and Matterport incorporated. But when we do come across the next few pages, we do see some of the ones that we have discussed today. But as always, it will really depend on what you are looking for as an investor. If you want to look at some of the diamonds in the rough, the individual stocks, or if you do in fact want to look at an ETF that gains that more sense of security and covers a lot more of these companies. As always though, do let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos, and we'll see you all on the next one.